as hard as you do. Join us on Classic FM for a refreshing conversation on building, managing, and preserving wealth the smart way. From practical financial insights to expert perspectives that help you plan for today and secure tomorrow. This is a show that puts your financial future first. Tune in every Monday from 5:30 p.m. to 5:45 p.m. for this insightful wealth management program, because informed decisions lead to lasting wealth. Only on Classic FM 97.3.
That's right. A very good evening to you. Welcome to tonight's edition of Wealth Management and You. My name is Chico. Joining me, as usual, our expert on the subject, Raphael Emenyonu. Raphael, how are you doing today?
Good evening, Chico. I'm good. Yourself?
Doing not bad.
Glad you're progressing, yeah.
I am delighted. I said it earlier. And it was a tough game.
It was a hard-fought victory,
I think overall it was. Our topic on today's show is setting and achieving financial goals, and this is one that's it's really important for everybody, because I often say it's easier said than done. We've got these goals, but setting them, then achieving them, that's an entirely different thing.
Absolutely.
If I had a penny for every time I tried to put money together towards something and then had to go there and find myself back at square one. You take 3 steps or 4 steps forward and then 6 or 7 back, and it's a tough one. So that's our subject today. Now, if you've got any questions that you would like to throw out right at the top of the show, please get in touch via WhatsApp and send those questions to us. Our number is 0704 1001 973. The number again is 0704 1001 973. And remember, the subject is setting and achieving financial goals. So, Raphael, like we do, how does one set goals?
All right, that's a good way to start.
Are there rules governing it? Setting goals? Or is it simply, well, I want to do this, and
there's a philosophy around it.
Okay.
Right. So it's not enough to say I'm planning for my retirement. It's not enough to say I want to start my own business. Right. When you're trying to set your goals, you need to align it with a SMART acronym. Right. And the SMART acronym is specific, measurable, achievable, realistic, or relevant, and time bound. So saying I want to start my own business, it's better to say I want to start my own business in the next 2 years or in 2 years. So that gives a time frame to it, so you know what you're chasing. You're not just running endlessly, in setting the goals. I want to begin my master's. It's better to say I want to begin my master's in the next 1 year, right? I want to travel to San Francisco in the next 6 months. So you know what you're chasing, you know the time frame, that you want to set for this goal, and you know when you need to achieve it, right? So it's very important that you align it with a SMART acronym. It needs to be specific, which means it needs to be clear to you. It needs to be clear that it's, it needs to be clear to you. It needs to be measurable. It needs to be achievable. It needs to be relevant, and it needs to be time bound. So when I say I want to start my master's in 1 year, and I say this downstairs, right, in 6 months or in 2 years or in 1 year, and I come upstairs and Chico is saying he wants to go on vacation in 1 year, and I quickly change that goal, that means it's not clear to me what I want to do. So it needs to be clear to me. It needs to be relevant to the things that I want to do. So does that master's, is it relevant for me to attain the bigger goal? Maybe the bigger goal is to become the MD CEO, right? And I need that master's qualification. So it also needs to be relevant in the scheme of things that you're trying to be in the bigger picture. It needs to be relevant, in the bigger picture at the end of the day. So you just need to align it with the SMART acronym, and And then that helps you, to form so that it doesn't become a dream. It then becomes a goal. If you're aligning with the SMART acronym, it then becomes a goal. But if you fail to align it with the SMART acronym, it probably might still be a dream.
So the T of the SMART acronym is
Time bound.
Time bound. So, before you set your financial goals, make sure that it is aligned with the SMART acronym. SMART standing S, specific, M, measurable, A, achievable, R, relevant, and T, time bound.
So an example of measurable as well is if you, for instance, let's say you want to start a pure water business, right? Maybe in the next 2 months, you should have identified the factory where you want to use as a factory, right? In another 2 months, you probably would have gotten your NAFDAC number. So you're gradually taking steps and you're getting closer, to starting that business, that you have in mind. So you need to have measurable steps as well, to say to yourself that, okay, even though the goal is going to happen in 2 years, right? In the next 4 months, where should I be? In the next 6 months, where should I be? So that's
and ideally where you should be is closer to the goal.
You're getting gradually, closer to where you want to be in 2 years. So you're not just going to say 2 years and then you sit back and then things will happen. No, you have to then begin to.
So you're an advocate of setting goals.
Absolutely, because it helps.
Why is it important?
So it gives you clarity, it gives you direction. I'm an advocate of starting with the end in mind, because once you do that, then you know the sort of journey you're embarking on, right? So it gives you clarity, it gives you direction, it gives you purpose. So you have something you're working towards. You have something that is driving you.
It even gives you a bit of drive. That's what I was going to say.
It gives you that drive, so you know that there's something that you want to achieve, there's something that's going to make you happy, because it's relevant to the big picture, the bigger picture, that you want to see at the end of the day. So yeah, I think that's very, very key, for me.
Interesting. Is there a process to achieving the goals, or how does one go about then achieving the goals? So you've set it, you've aligned it with the SMART acronym.
Yeah, you've seen the clarity, you've seen the direction, you've seen the peace of mind, which is also another important thing. There's a process, right? And this process can also be referred to as the financial planning philosophy, right? There are 5 key stages in the process. The first one,
5 key stages. Yes.
There are 5 key stages in the process. The first one is setting the goals, which we've spoken about, right? Clarity, aligning with the SMART acronym and all that. The second step is where your finances comes to play, which is where you need to identify your current net worth. So what you're doing essentially is you're looking at where you are today, right, in terms of your finances, and then you're looking at where you want to be in the next, the time that you've set for that goal is then where you're looking at where you want to be. So where am I today in terms of my finances? Where do I want to be in 6 months? Where do I want to be in 1 year? Where do I want to be in 2 years?
Yes.
That's essentially what you're trying to do. So you need to look at your net worth. Now, the same way companies tell you that they have financial statements, you need to see yourself as an entity as well. You need to have a financial statement for yourself, right? We're still talking about the stage 2, right? You need to have a balance sheet statement for yourself. You need to know what your assets are. You need to know what your liabilities are. You need to have an income statement for yourself. You need to know what your income is. You need to know what your expenses are. And at every point in time, to demonstrate that you have a very healthy financial status, your assets needs to be more than your liabilities at every point in time. Your income should be more than your expenses at every point in time. You need to try and have that balance.
And if this is not happening, then you're unlikely to be heading towards whatever targets you've set.
Yeah. And if it's not happening, then you need to introduce the budgeting tool that we've always spoken about, to help you track how you spend every kobo
Yeah.
That comes your way. So using the budgeting tool, you're able to understand how you spend money, because one of the interesting things that the budgeting tool does is that it helps you to give your money direction. Because the thing is, if you don't tell money where to go, it's going to go anywhere it finds. And that's why today, I'm sure if you speak to our listeners, if you ask everyone that's listening to us right now, we can start with the lowest level. There's a 5,000 naira that you can't account for every month. That's the lowest level
grand.
that you can't account for. You don't know where it's gone to.
Yeah. But it's gone.
It's gone. For some people, it could be 10. For some people, it could be 20. Some people, it could be 50. You just don't know where it is.
Some people, it could be 1M.
It's just gone. So if you have a budgeting tool in place, it helps you to give direction to your earnings. Otherwise, the money is going to go anywhere it finds, and you won't be able to trace it.
So does this take some discipline?
Absolutely, it does. There's so many things vying for the money. Unfortunately, majority of us don't have different channels for the cash flow.
Yes.
So it's narrow, So you also need to prioritize your goals. That's the third stage, and we're going to get to that, So you need to be able to identify your assets, your liabilities, your income, your expenses.
Mm-hmm.
So the difference between your assets and liabilities is what is called net worth. So that tells you where you stand.
That gives you
If
you were doing a financial health check,
that tells you where you stand. So if you've taken debt, if you're owing banks and all that, this is just going to ensure that you try and look for ways to pay up, so that you can have a healthy financial status, and then you'll be able to plan towards this goal that you've identified for yourself. The third stage is to, there's so many goals that people, if we had written it down at stage 1, I'm sure that so many goals that people would have written down, maybe about between 1 and 10, right? And if you look at all of those goals, that different time frame for all of them.
Yes.
So the goals you want to achieve between now and 24 months, 0 to 2 years, is your short-term goal. You need to break down
0 to 2 years
is your short-term goal.
That's your parents doing that one now for you, not the person. 0 to 2 years.
Yeah. Those are your short-term goals.
Okay.
Right? So you need to break down those goals. It's those into 3 key categories: short-term, medium-term, and long-term.
Okay.
Medium-term is what you want to achieve between 2 to 10 years. And then your long-term is whatever you want to achieve above 10 years. The reason this needs to be done, right, is because the different opportunities that you find, they're either suitable for short-term goals, or medium-term goals, or long-term goals.
Example.
So, if you're the type that prefers a savings account in the bank,
yes,
to keep your money, to
your
plan
money
for your goals, the savings account, because it naturally preserves your capital, is suitable for your short-term goals.
Mm-hmm.
It preserves your capital, pays you income, whether small or tiny bit. It preserves that capital. What is important to you for your short-term goals is that you want to preserve that capital. You don't want to gamble with it.
Yes.
You don't want any form of volatility.
Yes.
So
it is there, that's how you want it.
Exactly. If possible, you can decide to keep that cash under your pillow because you don't want stories, right?
That touch.
So, savings account, treasury bills, money market fund, fixed deposits, commercial papers, these are instruments that naturally preserves your capital, and pays you a predetermined income, and anything that does that for you is suitable for your short-term goal.
Yes.
Medium-term goals are the likes of
anything that does that for you is suitable for your short
for the short term. Anything that preserves your capital 100% and pays you decent income. It could also be suitable for people that are risk averse, that are also in that space as well. Now, for your medium-term goal, you need instruments that are a bit balanced, so maybe like a bond, which is an instrument that governments use in borrowing money, or corporates use in borrowing money. This also sort of holds onto your capital if you're holding onto it till maturity. It could be 5-year bond, it could be 10-year bond,
Yes.
right? And then it pays you every 6 months. It pays you what is called coupon, which is what you can refer to as interest, right? Every 6 months. Or you look for a balanced mutual fund. We discussed mutual fund last week. So if you missed that episode last week, you can go to our YouTube channel and try to get an understanding of what that is.
Mutual channel, give
The YouTube channel,
yeah.
Wealth Management and You.
Wealth Management and You on YouTube.
Yeah.
That's what to look for. All episodes of past episodes of the show are available on that channel. You can go watch them, download them, and so on. Do hit the subscribe button when you get there.
Thank you, Chico. So you can either use a bond instrument or you use a balanced mutual fund to achieve your medium-term goal. Because in that instance, you want to see the growth very slowly, or you want to see the decline very slowly as well. And then when you cross to the long-term space, the long-term goal space, you can then invest in things like stocks. We'll be talking about stocks at some point in other episodes. Stocks or real estate. These are instruments or other people's businesses or your business as well. These are opportunities that are suitable for your long-term goal, because it's expected that this instrument over the long term should be able to give you returns above what we call purchasing power, which is usually inflation. So that's what you do if it's a long-term goal. And long-term goals could be a retirement plan. If today you're still around 25, 30, 35, 40, you still have about 20 years, 25 years to plan for a retirement plan. So, those are long-term goals. Or you have a baby today and you want the baby to school in Harvard when the baby is 18. That's another long-term goal. That's another example of a long-term goal. So those are the sort of instruments that you can use to plan for those long-term goals. Now, we've spoken about the different instruments. Stage 4 of the financial planning philosophy then require you to take immediate steps. Once you're able to identify those different opportunities, and you're clear on the party that you want to also partner with, provide you with those instruments as well to be able to do your investments. Then stage 4 says that you need to take action immediately. You need to implement immediately. Do not wait. Do not procrastinate. Take action immediately. And then the 5th step says that you shouldn't.
Taking action immediately is that to avoid procrastination.
That's correct.
That's the sole reason why you take action immediately.
That's correct. Because you see, there's a cost for procrastination as well. And I'll give you an example. If I want to save 60,000 naira in 1 year, simple maths, that requires me to save 5,000 naira every month, right? January to December, and I'll get my 60,000 naira.
Yes.
If I push that to July, then what it means is that I'm going to make additional sacrifice.
Yes.
If the same time bound or the time frame that I have is still December, right? So that means I have to save 10,000 naira every month to achieve that 60,000 naira in 6 months. So which means I'm making additional sacrifice. So that's why the saying goes that the earlier you start, the better. However, the best time to start is now.
Today.
You just got the information as well. So procrastination just results in additional cost, additional sacrifice. So it's better to also try and do away with procrastination as much as possible. Then the 5th stage says that you should always review your plan, your wealth plan, your financial plan. Always review it. Don't just make the investment and go to sleep. Also try and get an understanding of what you're doing with whoever you're partnering with whatever house you're partnering with. And then once you do this investment, try and review. If it's short term, review every quarter. If it's long term, review between a quarter and 1 year. Always have a look at it, because your circumstances might change.
Yes.
Perhaps when you started, maybe you weren't married, and then you're now married. So circumstances has changed. So you need to look at it.
Perhaps you got a promotion.
Or you got a promotion, yes.
Or a demotion.
And if it's a promotion, you might need to add more money to whatever you're doing. And take more. And
if it's a demotion, you might need to reduce.
You might need to reduce. or look for other maybe aggressive opportunities as well, that can take you on your journey. So it's important that you review. Don't just go to sleep. If it's long term, try to do that at least between a quarter to 1 year. If it's short term, do that like every quarter. If it's balanced, if it's if it's a medium term goal, try and do that like every 6 months or thereabouts. Just so that you're keeping a tab on what's going on with your money, and then if circumstances have changed as well, you can immediately look out for other opportunities that you can also leverage on and tap into, and begin to get more value on that money. Okay. So those are the 5 key stages.
I hope you were taking notes, because these are things that must be put into practice if you are to set and achieve your financial goals. The experts have done these things. This is what works. And anything absent that, if you make it, it was purely luck. And luck sometimes runs out. And he who doesn't plan or fails to plan plans to fail.
Absolutely.
And that's what we're discussing. So let's look at some of the advantages and disadvantages. Advantages or disadvantages when it comes to setting goals. Are there any disadvantages?
Disadvantage could be that you have to, if it's not your field, you have to look for a wealth advisor to work with.
Okay.
It involves time. In creating a comprehensive financial plan, it involves time.
Yeah.
It's not just something that you wake up and you just do, and you expect to get the right results.
Mm-hmm.
So I think those are the 2 key disadvantages that I see. If it's not your profession, you have to work with a financial advisor or wealth advisor, to guide you through, which in some cases you might have to pay fees, right? And then the other one is it's time consuming, because you have to build that plan. But once you build the plan and you get the plan correctly, then you're home and dry.
There you have it. Let's remind you that if you have any questions at all today about setting and achieving financial goals, send those questions to us now via WhatsApp on 0704 1001 973. Again, it's 0704 1001 973.
But in terms of the advantages, right, it gives you peace of mind. You've planned for all your goals. It helps you to maintain your standard of living. So you sort of plan for every goal that comes your way: children's school fees, vacation, rent payment. So it gives you that peace of mind because you catered for everything. You plan for emergency as well. And that's very, very important. It's very critical. And that just makes it make sense.
Makes it make sense. I like that. So a lot of people are still of the thing that as long as I am making savings, I'm safe, and tomorrow I can always go there and pull out money. And so when it comes to this setting goal thing, a lot of people are just drifting along. What would be your advice for such people?
So you're not getting the optimal return. You're not putting your money to the maximum level of work that you should put it to. Imagine you working so hard, to make money, and then you're not sweating the money you're making hard enough, to make the maximum that it should make for you, but you're only scratching the surface. You're only getting the minimum from it. That's what happens. But by the time you plan it with the right instruments, then you're getting the maximum value from that kobo. Every kobo that you put aside, you're ensuring that you're getting the maximum value, from it. And that's really how to build wealth.
Okay. All right, we have this question. This is from Emeka, and he says, "Good evening, sir. My name is Emeka. What do you know about Empower?"
No idea.
There you go. Not our subject. So
no idea.
Do stay on point. You'll be able to achieve it. Okay, as we wind down now, what advice would you give those listening when it comes to setting goals and then achieving them. If you could leave one nugget that should stay forefront in the listener's mind, what would that be?
Discipline is very, very important if you want to maximize the potential, that comes out from your hard-earned finances. Yes. Discipline is very important. And if you haven't started, the best time for you to start is now.
Right.
Now. And desist from procrastination. You asked for one, but I've sort of said three.
My uncle says delay is dangerous.
Yeah, it is.
All right, we have a few questions here. It says, good evening. For somebody who wants to start now, but already has some outstanding debt to clear, please, what would be your advice?
You need to pay off your debt. You need to pay off your debt. First of all, you need to try and clear your debt. I don't know what those debts are meant for. I don't know if it's because the ideal way to go into debt is to ensure that you're also making more than the cost of borrowing, so that you can pay it off. But if that's not the case, try and pay it off as quickly as possible, and then restructure your finances in such a way that whenever you're taking debt the next time, you're putting it to use in such a way that your returns are more than your cost of borrowing. So you need to pay off the debts, first of all, clear the debts.
All right, Kingsley, I do see your message, but this has nothing to do with our subject today. So we will not be taking that. Our topic today is setting and achieving financial goals. So if you have any question relating to what I just read out, please send that question through. And I'll put it to Raphael. We still have a couple of minutes before the end of today's show. So if any pop in now, I will certainly be asking them. But I did ask you to give a final bit of advice to listeners who are struggling with setting and achieving financial goals.
Like I said, discipline is key. That's the first thing. You've got to be disciplined. Desist from procrastination. Take the action. And move quickly. And if you haven't started, the best time for you to start is now. It's never too late. The best time for you to start is now.
And there are people that can hold your hand through it, so you might want to find them.
There are people. Yeah, there are people.
Okay, this has been Wealth Management and You. You're on Classic FM 97.3. Comes your way at 5:30 every Monday. So we're expecting you right here at 5:30 next Monday, and be blessed as you come. Raphael, thanks a lot for coming through.
Thanks, Chico. Have a good evening, Lagos.
We will be rolling on with TDS in a few clicks, but first of all, a bit of a break.